up, creatives? Welcome to the Tiffy Show. Today I will be telling you how to find and invest in ETFs. If you haven't, make sure that you turn on notifications so that you know when I post a video. I like to post about lifestyle, dating, travel, investing, and everything in between. So if that's your jam, hit that subscribe button and let's get to it. Quick disclaimer, I'm not a financial advisor. These are just my thoughts and opinions. Take them with a grain of salt. How to find and invest in ETFs. I love ETFs. I think they're a great investment tool, especially for beginners or people that just want to, not put so much research into their stock portfolio. They want to put their money somewhere and let it grow over time, knowing like it's well diversified and it's covering all their bases in terms of risk and all of that. So I like ETFs for that. Make sure that you watch until the end of the video where I will give some of my favorite ETFs that you should look into if you're just starting out and you want some safe options that have been around for a long time. What is an ETF? An ETF is an exchange traded fund, and it works similar to a mutual fund or an index fund, but the difference is it's not as managed as those, so it has lower fees or no fees, but it does the same thing, which means it usually tracks a sector or an index. So it's a really good way to invest in a whole lot of stocks, a whole bunch at once. ETFs can follow any kinds of securities, whether stocks, mutual funds, bonds, so you can always find something that fits what you're looking for in terms of the sector or the industry. ETFs have a lower expense ratio just because they're not as actively managed as a mutual fund, and that's great for you because that means that you're not paying all these fees to have your money in an ETF. Usually mutual funds have a manager or a managing team that actively looks and finds the stocks to put into this fund and to invest your money into. With an ETF, it's usually just marrying an index, so it's just investing in exactly what's in that index or what it's telling you is in that index. Like for instance, you might pick an ETF that does just technology. It'll follow all the tech startups and tech industry stocks. Expense ratios for ETFs can be lower, and just to give you an example, and I'll get into expense ratios in a moment, the average expense ratio for a ETF is 0.25, whereas the average expense ratio for a mutual fund is 0.76. And the expense ratio is the amount of money needed to, manage the fund and just cover the cost of having the fund, and that trickles down to you. So you want a lower expense ratio over time because it will add up. So I always like to pick ETFs that have a lower expense ratio, and sometimes you can find them as low as 0.03, but I will get into that in a moment. But I just wanted to quickly give you an example of the difference between an ETF and a mutual fund. ETFs are similar to stocks, and they're attractive to investors because they invest in so many stocks at once, putting a little bit of money into everything that you're interested in. So it's a great way to diversify your portfolio. Now with ETFs, sometimes you do have to pay commissions and fees. That's why you need to pay attention to the brokerage that you're using to see what those commissions and fees are. Webull and Robinhood do not have fees associated with commissions and stuff like that, so I think you're good if you do your investing through them, but always make sure of that because sometimes, people go back to the old school and they hit you with those commission fees, but there's so many now that have no fees. So make sure when you're looking for your ETF investing that you find ones that have no fees. Just search it in Google, brokerages with no fees, no commissions, and you'll find a ton of them that you can set up. What to look for in an ETF. Now, as I mentioned before, you want a low expense ratio. I like to pick ones that have an expense ratio of 0.25 or lower, and that's like a first thing that you can look at. It's right on their profile, expense ratio, and you'll see the number. So 0.25 and lower. The expense ratio are the total assets needed to keep the fund operating, so you just want a low one so that you're not eating up so much of that cost. ETFs can be just as volatile as stocks, so you want to make sure that when you're looking at them that you're finding ones that are broad and follow an index. Now you can of course go to ones that are more niche-y, like for instance only in the healthcare industry or only tech. Those do have more gains over time, they have more growth potential, but they're volatile. So just like stocks, you can lose more money in those if it doesn't work out. So it's always good to, when you're starting out with ETFs, that you stick with ones that are following a broad index or S&P 500 or something like that, so that you know it's more safe. When researching ETFs, make sure that you glance at what industries are included in that specific ETF, because just because it might say it's not volatile doesn't make it true. Just glance at the companies and make sure you're okay with all the companies that are at least in the top 20, because those are the ones you're going to be investing your money in. This is also the time to say if you have issues with certain companies in terms of personal issues, or you just don't like the way that a company works or their morals or their ethics, an ETF is going to invest in anything regardless of your feelings. So you can't remove stocks, you can't put stocks in ETFs, you get what you get. So make sure that you look at the top stocks that are in an ETF to make sure that they fit what you want to invest in. Liquidity and trading volume. This is really important. I don't know if I said liquidity right. Why does it sound like someone's weird name? I'm gonna write it down. I say things weird, you know, it doesn't mean that I don't know what I'm talking about. I just say things weird. But anyway, you want to find ones that have good liquidity, which means that you can take your money out of them really fast if you need to. And how you check that is you don't want to see a large spread between the ask and the bid. It just means that the money's not flowing enough through that to get your money out really fast. In order to check this, you want a high trading volume. Specifically, you want trading volume in the millions. And you can look at the average daily trading volume and see if it's flowing the way that you need it to. You want a trading volume in the millions, and again, you find this with the ETFs that follow a broad index and follow a lot of stocks that are, you know, in the S&P 500 and things like that. Just to give you some context, the top 100 ETFs all have trading volumes of 3 million or more. So when looking at that trading volume, you just want to see millions or close to it. The higher, the better in terms of trading volume, because it means you can get your money out quick. It also means that people are investing in that ETF. That's good for you. That means a lot of people have faith in this ETF. Good history. You want to find an ETF that's not brand new. I'm not saying that brand new ETFs and things like that can't make you money, but as a beginner investor, you want to make money on things that have a history of making money, because ETFs can go under, they can close, so you want something that's been around for a long time. I say that the minimum is 3 to 5 years, the longer the better in terms of an ETF's history. Now you can find this looking at their profile and you see what year they started, and then that's how you know how long they've been in the game. When you look at their profile, you also want to see a low minimal tracking error. Again, it's on their profile, it'll just say, you know, minimal tracking error. And for example, there's ones that are like 0.05, and that's great. It just means that whatever index they're following, they don't mess up in terms of, you know, how they're following it and how they're reporting the numbers. It gets nerdy, I'm trying to simplify it, but you just want that to be low because you want your portfolio to equal the index. So this is the tracking error is minimal. That means that it's doing a really good job of tracking the index that it's following. Last, you want to look at the assets under management. This is all of the money that they're managing. This is all the investors' pooled money in this ETF, and you want it to be high because the more money in this ETF, the more people believe in this ETF and they think that it's gonna make them money or it has made them money. You want an AUM of 10 million or more. Anything below 10 million, you wanna kind of steer clear from, and 50 million and up is even better because it just shows that a lot of people have faith in this ETF, they have funds, and they're not gonna just shut down out of nowhere and not be an ETF anymore. So this means that this ETF has a better chance of longevity, and this is a good one for you to put your money in. Those are the main things you need to look into when you are deciding on an ETF. And just to review, because I know I threw a lot of information at you at once, I'm going to review everything. You want them to have been around for a while, so a good history, a low expense ratio, high trading volume, low minimal tracking error, and a high assets under management. And as I promised, these are my 7 favorite ETFs to invest in, especially for beginners. These are the more low risk, but have a little bit of everything for you. And take the knowledge that I just gave you and put into researching these, finding your favorite ones, seeing which ones fit what I explained to you. And you know what? Then you can put your money into it and the rest is an investment. If you enjoyed this video, make sure that you share, like, subscribe, and comment. Comment below and let me know if you've invested in ETFs and your thoughts on them, and I will see you next time. Stay creative.